evening, everyone, and welcome. The topic of tonight's discussion is distressed debt, and we're very pleased to have with us Sean Armstrong of Westport Capital. Sean is, among other things, a longstanding member of the Lusk Center board and is, I think, one of our most insightful board members, and has made a pretty decent living thinking about how to invest in distressed debt. So, Sean, thank you for being with us tonight.
Thanks, Richard. I appreciate the time.
So I always start these conversations by asking people to just tell us a little bit about how they got to where they are today. So if you could just walk us through your career progression, starting as early as you like, but ending sort of close to where we are right now.
Okay. All right. Well, I'll skip preschool. So actually, I had a bit of a career detour. I actually went to medical school and realized I didn't want to do that. So part of the way through there, I left. And then I had to spend the next 5 or 6 years figuring out what I was going to do. Was fortunate enough to be admitted to the USC MBA program with a view to entering finance, not really knowing exactly how I would do that. And upon graduation, I got a job at Trust Company of the West in the high yield credit department as an analyst, and spent about 2 years there. At the time, that group was closely aligned with a corporate distressed group. And in the early 90s, which is when I graduated and started work, the S&L crisis was still evolving and being worked through, and they began to see a lot of real estate related distressed debt coming through the desk. I had spent some time prior to business school in real estate related arenas, so I kind of put my hand up and said, you know, I'd like to be involved in this effort. And they quickly assembled a group of us and raised about $500 million for what was then called a distressed mortgage fund. So we all got kind of a baptism by fire in the 90s, buying distressed assets, figuring out how to go through foreclosure, figuring out how to deal with bankruptcies. Some of that was occurring on a single asset basis, and some of it was occurring at a corporate level. So our unifying theme was always that there was some meaningful portion of the asset base that was real estate. And sometimes that was buying distressed properties or distressed loans. Sometimes that was buying distressed securities, principally debt securities. So we had the opportunity through the course of the ensuing 10 years. And I should note actually that about less than a year actually after we formed the fund, an entire floor of TCW moved out to form Oaktree. So actually the majority of what I was just describing was my time at Oaktree starting in 1995. And so we worked on large corporate restructurings, many of which would be familiar to folks today. Some of them were single asset deals where we were buying the loan or buying a distressed asset from a lender that had already foreclosed, and then figuring out what to do with it. And as recovery began to evolve, we began to evolve as well and became more traditional real estate investors, buying assets that needed to be turned around, that needed to be repositioned. We went through, obviously, a few cycles. We went through the Russian debt crisis in '98, long-term capital management. We went through the tech crash at the beginning, really late, well, I guess the beginning of 2001, and then that was doubled up by 9/11 in 2001. And then began to participate in a recovery that ensued from, say, 2002 to 2006 or 2005. And that's when a group of us that were in the Oaktree real estate group, it was the senior group, we left kind of around the same time to form Westport. And that's where I am today. I'm the managing principal of Westport Capital Partners. So this is actually my longest stint at, we're completing our 15th year in December. And so, shortly after we started Westport, we then had the great financial crisis. We had to manage, our existing investments as well as try to find ways to take advantage of the opportunities that were being presented to us. And then, the recovery started probably in earnest in 2010 in a very slow fashion. Again, working on individual distressed assets. We actually were part of a group that capitalized a de novo bank. So that was an interesting process to go through and start to acquire distressed banks through the FDIC loss share process. And then, as the recovery continued to evolve, we evolved also. Again, came back to more of the single asset renovation, repositioning. That really wasn't a lot of distress. There were some distressed deals to do. Other distressed assets, again, that were owned by banks or other lenders that we acquired. In some cases, we acquired the loans. In some cases, we even acquired CMBS debt. We had a few situations where we bought the controlling classes of seriously distressed CMBS deals and oversaw the workout and disposition of those assets. So we've done a lot of stuff. We found ourselves late cycle in 2019. We went through a leadership change at the firm. The partner who had been our managing principal retired at the end, and I stepped into that role. And then COVID hit and turned the world upside down. So today, we'll talk more about that. But today we find ourselves in some very interesting times. So that's the history.
So I want to take you through that history a little bit, though, as we move back up toward today. So take us back to the aftermath of the savings and loan crisis and the Resolution Trust Corporation. I mean, this was sort of the beginning of this being a business model, is sort of looking at the assets that had failed and determining which ones were worth buying and which ones you wanted to take a pass on. Since there was really not a lot of history in doing this kind of thing, how did you go about making those sorts of decisions back in the 90s?
Well, and you have to appreciate that that was 25 years ago. So we were all, pretty young and given a lot of responsibility. And the leadership was only probably, 10 years older than we were. So they had a lot of experience and had gained just in the years before us, not a whole lot earlier, but realized that corporate distressed investing probably started as a business in 1991. That's when Howard Marks and Bruce Karsh raised the very first TCW special credits fund to buy distressed assets. So we had some roadmaps in terms of what bankruptcy looked like. Bankruptcy law was on the books. It was evolving. Foreclosure, varies state by state. So we had to understand, are you in a judicial state, in a non-judicial state? What does that mean? What's the pathway? And then, one of the main differences that we had was when a distressed loan asset is in the hands of a lender of any description, specifically regulated lenders, they're under very, very tight constraints. In terms of the flexibility that they can have is very limited. The workouts that they can do with the borrowers are very limited, and so it's a very value destructive sort of a process for a lender to actually, take an asset back onto their books and then try to figure out what to do with it and then sell it. We built all our models from scratch. This was pre-Argus. Argus was sort of out there kind of maybe for the very, very core type of assets. We were doing all of our work by hand. And when you say work
by hand, I mean, were there like shopping centers that had 300 tenants in them and you had to sort of ride out tenant by tenant what was going on?
Yeah, we had to do that. We had to do that with office buildings. We had to do that with hotels. We had to do that with casinos. We did that with, a wide variety of different types of assets and trying to figure out, what do you do here? And realize, we were in an economic crisis that doesn't just affect the real estate. Part of the reason the real estate's in crisis is because the revenue streams were interrupted because the tenants stopped paying. So you had to figure out, what do I do to get control of this asset? Sometimes both from the landlord, the existing owner, as well as the tenant. Sometimes, and this has been a persistent theme, sometimes you can have a tenant that's doing fine or a tenant that wants to come into a building, but you have a situation where a landlord is undercapitalized or they're underwater. We saw a lot of this in the post-Great Financial Crisis. We saw a lot of this at that time also where, the analogy I make is, if you had a loan that was at 70 cents when the property was worth par, and now the value of the property is dropped to 80, what's the motivation of that that owner to put more capital in because his basis is already so high. So, what can be done to reset that basis to make it economically viable for an investor, whether it's that owner or a future owner, to invest capital? You may have, we had situations where we had tenants ready to go, ready to sign a lease, but needed to know who's going to pay their broker and who's going to pay for the tenant improvements. So a lot of that basis reset had to happen through that process. But I don't want to say we were making it up as we go. We relied heavily on our lawyers to help us try to understand the legal processes. But in terms of figuring out what to do with the property, I mean, a lot of times you're sitting around being as creative as you can, trying to figure out how to navigate that.
So were there examples of, so clearly you had some home runs, right? Were you able to?
We had some home runs, we had some singles, and then we had, some of the three strikes are out.
Yeah, well, and so tell us a little bit about, people like to hear about stuff that doesn't work out so well, and then we come back and talk about your triumphs. So give an example of something that just didn't work out, no pun intended in this case.
Sometimes cheap can stay cheap, and sometimes things can appear very attractive because the price at which it's being offered to you represents some dramatic discount to either the face amount of the debt or the price at which the property had traded previously. We have relied a whole lot less on appraisals because appraisals are a moment in time. They're very, very backward looking, and I don't want to denigrate the appraisal industry, but they serve a function in a certain way.
Well, they're kind of required to be backward looking. That's their rules that they have to do.
And there's a challenge involved, especially in a declining market, right? But so one example that was a complicated situation that ultimately worked out okay, but it was rough. We started acquiring bonds in a distressed bond. So in the capital structure was a publicly traded hotel company. They had a lot of individual or group property level mortgages. They had bonds that traded, and then they had some trust preferreds that were the complicated security called a trust preferred, TRUPS they call them, and then there was the common equity. And this was a post 9/11 scenario where they were struggling, but we were looking through the assets and looking and trying to understand where does the value level fall. We talk about where's the fulcrum security in the capital structure, the point at which you can experience the most upside and your downside sort of protected. So the mortgages really weren't traded because they were trading because there were senior secured loans, and they were well covered by value, we thought. And then we had the bonds. The trust securities were in a small number of hands and not that interesting. And frankly, we looked like they were out of the money. The common looked like it was out of the money. So the bonds looked like they were the fulcrum security in the right place to be. So we acquired a meaningful position in the bonds in one of our Oaktree funds, enough to give us a material say in what was going on in with the company. Our Blackstone, frankly, was another big holder of bonds at the time. And so we were acquiring the bonds, and then ultimately, the company got to the point where they had to file bankruptcy. And so we thought, okay, that's good. We'll get control of the assets. The challenge was that the bankruptcy filing also triggered a lot of defaults on the underlying loans, and we thought there would be an adequate cash flow in order to keep them covered, but those lenders got very aggressive. So ultimately what happened was we ended up on the board. We converted the company. We brought them out of bankruptcy. We installed new management, but the properties then just never really performed as well as we would have liked. They required a lot of capital. They were older property, and frankly, we probably could have done I could have done more work on understanding the underlying assets better. It probably took too much of a macro view, just looking at value. Ultimately, we made fine money. I think we ended up making a high single-digit IRR on the investment. And eventually, the company was sold and wound up, and then we left. But that was one where, I learned a lot about what it's like to buy, what appears to be a senior enough security. But I think it was Liam Neeson in one of the Star Wars movies said, there's always a bigger fish. And so those senior mortgages were, something to deal with. So a lesson, frankly, that we carried forward into the great financial crisis when we were looking at, we were offered when securities were all under pressure at all levels. And we learned, the application of that lesson at that point was, give up a little perceived upside in maybe buying a secondary security and go for the senior layer in the capital structure, because ultimately at that point you're controlling your own destiny in a way that you wouldn't be if you're getting squeezed in the middle.
So does that mean you find mezzanine debt particularly appealing nowadays, or did you move more toward mezz debt? It seems like that would be the fulcrum.
Well, so mezzanine debt basically is the same thing. It doesn't have a CUSIP. Mezzanine debt's basically high yield debt that sits between the senior secured and the common. So in a traditional real estate structure, that's the mortgage, and then there's the property owner. It's an analogous capital structure. So mezzanine, I think, is a tricky place to be. I think originating mezzanine when times are really good is a dangerous prospect, because if the cycle turns, one of the things you need to look at, like I always get nervous when I see someone saying, well, here's a $20 million mezz piece you can buy, and it's got a 12 or 13 or maybe a 15% coupon on it, but you're sitting on top of $100 million of senior debt. You need to make sure that you can service that $100 million debt if you find yourself in possession of the asset, especially if cash flows get compressed. I think what's interesting right now is we are starting to look at whether you call it mezzanine debt or preferred equity. We're seeing some interesting situations where people are looking for capital, particularly in hospitality right now, and you can reset, the basis, if you can get comfortable with where the last dollar of that senior is, and if you feel like you can adequately, service that debt if it came to that. But that's an interesting. I think that's going to be an interesting way to provide capital rather, to some of the distressed situations that we're starting to see now.
The reason I asked is when you look at this sort of what I'll call this generation of CMBS, the post-GFC generation, their LTVs are usually pretty low on the
Right.
CMBS, but they almost inevitably have something in between them
Yes.
and the equity. And sometimes it's quite substantial.
So we haven't seen. So what's been interesting is we've been waiting. And you and I talked about the timing of this when we set up the timing for this conversation. I had said earlier this year that we need to wait till later in the year because the banks are not under much pressure to sell because they've been given latitude by the Feds. And I think similarly in the CMBS world, because the last dollar for a lot of CMBS is at 50, so there was a thick tranche of mezz above that. It's just that mezz hasn't started really to trade yet. I've actually been shown a deal. So I'll give you a counter example of that actually. Somebody's showing us a deal where we can potentially buy the mezz on a group of 4 assets. They are hospitality assets in major cities, primary markets. The original structure was, I think, about a $200 million first CMBS, a $75 million mezz piece, and I forget, and a very large, well-known asset manager was the equity in that deal. And I think their equity might have been thin, so maybe it was 50 to 75 million. I can't remember. But it's an Asian insurance company that owns that mezz piece. They thought they were buying kind of a tuck-away piece of paper, and that can probably be had at something like 30 cents on the dollar. So that means the equity's a wipeout. They've already given up. I think that the mezz holder is going to lose 2/3 or 75% of their equity. But again, that sounds attractive on the face of it, but the securitized debt is due in a year. So, you can only fathom stepping into that, A, if you can equitize the debt, which probably is not economically interesting, but B, if you can negotiate an extension on that so that you've got runway to be able to see your way through a recovery in the hospitality industry. So this stuff's only starting to creep out now, Richard. You're not really seeing it. And what's interesting is that the CMBS market, even in hospitality, has been remarkably strong. We in one of our funds, we bought the junior most tranche in a CMBS deal on a hotel that I think we paid. It was one of our securities funds, so a kind of a lower return oriented fund. I think we paid 80 or 85 cents on the dollar for it, and that's the last tranche. So you would have thought, and it's not a very thick tranche. You would have thought in a environment where there's a tremendous amount of hospitality distress, you'd see securities start to trade at much steeper discounts, and they're not.
Again, that's in part because the LTVs on them in the first place were quite low.
I think even in the absence of cash flow, people are comfortable to say, look, my basis here is so low that I feel very comfortable in this spot. And frankly, the special servicer will be the one sort of keeping the senior tranches current, at least for a while. I don't have to do anything. So it's interesting. There's been some other nuances too, because this is what's referred to as a SBY bond, which is single asset or single borrower bond, and this is on a single asset. So, which frankly has some interesting nuances, both from the lender and the borrower side, because it in some ways it evens the tables for the borrower. Because if you're one loan in a massive, 300 asset CMBS deal, and your loan's going sideways, you don't have much say in it. But if you're the borrower in a deal and you're the only borrower, gives you different leverage. So the next 12 to 24 months is going to be interesting to see how things play out.
So tell us more generically, how do you go shopping? So you're sitting in your office and you're thinking about what you want to acquire next. What is your process for doing that?
Well, our process, so prior to my having changing the direction of the firm, and really since taking over this position, we'd had a bit of a go anywhere, do anything mentality. We realized a few years ago that was, we needed to not do that, because frankly, we were getting late cycle. You needed to really understand kind of what was going on. There's been a couple of major demographic shifts that have gone on in the United States. You and I have talked about this. It's outflow from California and outflow from the Northeast. And the outflow from California is going to the Western 10, ex-California, for the most part, and the Northeast is going south. The Southeast is getting bluer politically as a result of all that migration. You have some cities in the Midwest that are bright spots, and Boston's a bright spot. So what we did last year, pre-COVID, was we took a very deep dive on what economic factors we thought meant the most, looked at the top 100 MSAs in the United States above 1 million people, ranked them all, and took the top quartile and said, this is where we're focused. There's another 4 or 5 that are kind of secondary markets that we're kind of focused on. And we said we want to stay 100% focused on these markets, because this is where the people are going. You've seen this from me before. This is where the jobs are going. This is where the companies are going. This is where affordability is the best. It's where you look at some qualitative factors, lifestyle factors. It's where people are going. And so our shopping list starts with all the places we're not going to go. So deal shows up that's not on that list. These days, we're not doing that. And frankly, we're strong adherents to the K recovery profile from in COVID. We are seeing growth happen. I've been actually traveling. I'm in Scottsdale, Arizona right now. I've traveled every week for the last 8 weeks, mostly for work, looking at deals on the East Coast, on the West Coast, and some of the places we're talking about. And there's real growth. There's real energy going on in some of these places. You wouldn't think it from watching the news, but I was in Charleston and Charlotte and Atlanta last week, and there's lots of activity going on. I was in Boise Boise said the pace of their influx from Northern California has accelerated. So our shopping list starts with knowing what markets we want to be in, and then we've gotten very refined in our thinking in terms of product type as well. And so we are at the same time both distressed and opportunistic investors these days. On the distressed side, you have a lot of distress in retail and hospitality, and we're not that interested in retail. I think it'll be, a very special property that gets our attention there. On the hospitality side, I think we're very, very hopeful that we'll see some interesting opportunities emerge from this. And again, got to be specific in terms of product type, market orientation for the properties, and then the markets that they're in. And then, so that's on the distress side. I don't know that we're going to see a lot of distress in housing or industrial. Frankly, we're much more focused on the growth elements there. We're actually, we committed yesterday to probably our second development deal that we've committed to during COVID for residential. We just bought 55 acres here in Phoenix to build 1 million square feet of industrial space on, because the West Valley here is exploding. We're looking at some housing deals here as well. So, it's a very bifurcated market. I say that all the trends that were in place pre-COVID are accelerated and magnified, whether it's on the way up or the way down.
So I'm interested in that you find that there is some promise in hospitality, because one of the things that happened in the aftermath of 9/11, it took about 6-7 years before travel returned to pre-9/11 levels, and then the global financial crisis hit, and then coming out of the last crisis again, it took several years. And so, how many years are you thinking it's going to take before hotels are filled up again? Or again, is it just very market specific?
Well, so far be it from me to argue with you when it comes to data and statistics, but my sense is that the travel returned quicker than 6 or 7 years. Now, you may have data that...
I'm just looking at things like if you look at just number of people that got on an airplane in a year, that kind of thing.
Well, and so if that's the case, again, that sort of surprises me, because I would have thought that it recovered quicker than that. And certainly, did any of us get on an airplane in 2017, 18, or 19 that wasn't packed? The recovery profile in hospitality is going to be, I think, very specific and not broadly spread. I think that you started to see already. It's interesting. I get national statistics on occupancy, RevPAR, and ADR, and you're starting to see in the lower price points that the RevPAR numbers they're still down a lot, but they're down like 25% against year over year, where I would have thought they'd be down 75% or 50%. So, and as I said, I've been on planes, a number of planes in the last 8 weeks, and while total capacity seat miles are down, the planes are filling up. People are traveling. Charlotte Airport was frankly not at pre-COVID levels, but probably at 70% or 80%. So for us, our focus initially is on limited service that doesn't have a big food and beverage requirement. That wasn't a big component of revenue. Leisure orientation and drive to markets that can survive without a lot of airlift coming in. Hawaii being the poster child for the opposite of that, right? And so I think the recovery profile is going to be that's going to come back, like just anecdotal evidence. I was on a call last night for my son's soccer team. They're starting to talk about travel soccer tournaments again. Again, not anywhere near the same level, but so those kind of hotels, they're going to start to see that business recovery. I'm not interested in a Marriott Courtyard on a cloverleaf somewhere in the middle of the country, but if I had a limited service hotel that's in a Monterey or San Diego or maybe even San Francisco, potentially, where you've got tourist, or Napa, as an example, you got tourist traffic coming back, that'll be interesting. I think that the business-oriented travel is going to be slow to recover. It's definitely a post-vaccine. Once we have vaccine widely deployed, I think companies will begin to allow their their employees to travel. They're certainly not going to encourage them. So I think, it's a late 22 when, maybe mid 22, when businesses really sort of take the reins off of business travel. And then I think, the far end, the caboose on the whole train is group. So large group type of, the Millennium in New York, I mean, God knows when, what's going to happen to a property like that, or any of the big convention hotels in San Francisco or Chicago that are oriented towards, even Vegas, oriented to 50,000, 100,000 person conferences. That's a 24, 23, 24 kind of recovery in my opinion.
So just
to sort of say it, you asked me about, what do we do in the S&L crisis as we fretted over every last little thing. And then you looked back in 1998 and said, I should have bought everything that was offered to me at the time, right? So I was speaking to a very senior guy in the hospitality industry who just, his timing was impeccable. He retired at the end of last year. He said, I think we're going to look back in 2023 and say we should have bought every hospitality asset that was offered to us because, they will recover. That's not how we're going to do it, but I have a sense that, there's going to be that element to the recovery.
Well, again, I mean, there's no doubt that they will recover, but time does matter, particularly from a liquidity standpoint. And again, I was trying to find the data. I will find it before we meet in class about air travel after 9/11. But I'm pretty sure I'm right. It was like 2007 before it was.
As I said, I'm not going to argue with it, and I'd love to see it.
And so, but that length of time, and when it comes to the question, so you say you're traveling every week now. Are you comfortable getting on airplanes?
Well, so a dirty little secret. I fly myself a lot, Richard. So I flew myself to Scottsdale.
Okay. Well, that's not fair then.
I'm cheating a little, but I'm in hotels. I'm staying in hotels, and like Scottsdale, I've been here, as I said, a number of times. The restaurants are open. You can eat indoors. They're packed. Everybody wears a mask. Once they walk in to get to the table, they can take it off. When I was in Atlanta. I was in Charleston. I've been in Portland. Now, Portland's a whole other story. But, tourists on the streets in Charleston, the city, again, a subset, a fraction of what it was, but not 20% of what it was, maybe 60% of what it was.
So, well, if you look at open table reservations, which again, I like looking at data a lot too, is there seem to be back to about 65% of where they were a year ago. And of course, 2 or 3 months ago, they were like 10 to 15%.
Right.
So there's no question there's been some recovery. The reason I asked you about the plane question is I actually am comfortable with the idea of being on a plane because they're become very good about enforcing masks on everybody.
Yes.
And, the CEO of Delta personally bans people who don't wear masks, and I appreciate that. The issue for me is going through the airport and where enforcement may not be quite so good. So there's a level of risk that I'm willing to take, but it only goes so far. Hotel rooms, I think, are very safe. There's no evidence that they're a problem. They're clearly, first of all, it just seems like picking it up on surfaces is not a way that it's transmitted very often, and then they do good cleaning. But it's a question I'm asking people because until people are really comfortable with the idea of getting on airplanes, it's hard to see how this recovery happens.
Well, I don't know. So again, just give you some anecdotal evidence. First of all, most hotels are leaving a day between guests when you check out. So in certain ways, occupancy is being a little suppressed. I was looking actually at a wide variety of hotels to come here. I saw a number of them where there was only a few rooms left, so they're limiting their capacity, but I think they're yielding better. So at the upper end, it's not like you can gut a $700 hotel room for $300. You're going to pay $700. It's just not going to be not as many of them as there would have been. So they're suppressing capacity. Same on the airplanes. They've taken a lot of routes out of service and planes out of service, but all the flights that I were on were either full or nearly full. And again, I think that's, so I think as we increase capacity, I think there's probably some pent up demand that's not being met.
So last question, you said that you are avoiding shopping centers, and I think the reason for that is pretty obvious. It's hard to see a good picture for shopping centers going forward for reasons that go well beyond COVID. Is there were comorbidities in retail before COVID came. But do you see there to be some of these places to be opportunities as land plays? So they're well located. Could they be turned into industrial space? Could they be turned into garden apartments? And if you look at if you look at acquiring particularly distressed debt on them as the cost of land per square foot of the land, might there be an opportunity there?
Absolutely. And, most shopping centers have the best, locations in an urban or suburban environment, right? They're on main streets. They've got good access to transportation, good circulation. I think that it's going to be, interesting. Like what I'd love to have is some local developer come to us and say, look, here's the property. I've already talked to the city. They are going to be okay with turning the Macy's into a distribution center for Macy's or part of it for that, or part of it's going to be self-storage. They're going to give us residential zoning. We can take down part of the thing and build, 200 units on it. And I've seen a few of those deals. We missed on one in a northern suburb of Atlanta. Those are going to be the really interesting opportunities, but they're going to take time, because I think it's rare to have, and I don't mean to, again, cast aspersions on an entire class of people, but it's rare to have a city council or planning commission that's so forward thinking, or not have a lot of resistance from anti-development groups to be able to move that process forward quickly. The deal that I just mentioned, the city actually owned it. They'd owned it for 7 years before a developer was out seeking capital to do that. So I think that some of those could be interesting as alternative uses, and could be a wonderful, renaissance for retail if they can become mixed use kind of projects.
So Sean Armstrong, thank you for taking some time with us this evening. Really great to hear your views and to hear your very different sort of strategy for acquiring real estate, particularly at times like this.
Thank you, Richard. I appreciate the time. Always good to see you.